Hello again, Investing Putts back with you. It's been an interesting week or two, to say the least, with this Ukraine situation. So I hope you're doing okay during it. I recently subscribed to Finviz Elite. I played briefly with the free Finviz screener, and I found that all the good stuff seemed to be hidden behind the paywall. So I took a flyer. I think I paid $35 for a 1-month subscription, and I could have gotten it for much cheaper per month, like $250 for a year. I got the subscription because I wanted to get into small cap. I wanted stocks that weren't in the Russell 2000. I didn't want the price action to be contaminated by being in a passive index like your S&P stocks that are grossly inflated because of that, in my opinion. Also, with the small caps, you tend to get much cleaner pure play companies, not large conglomerates with diversified businesses. So here's a view of the Finviz screener, and the yellow boxes are the fields that were active for my small cap screen. So the first box I selected was I want U.S. stocks. Companies that have a market cap below 2 billion are typically not in the Russell 2000. That being said, I wanted companies that had a market cap greater than 500 million. So I don't want micro caps or penny stocks. I want the stock to be above its 20, 50, and 200-day moving averages. I want something that this is trend following. I want something that has a trend, positive trend. So I'm looking for stocks like this. This is Arch Resources, which is a coal company. For the last year, it's been in a pretty steady run-up, and of course, since the Ukraine war, things have gone crazy with it. But even before the war, things are doing pretty well. So as you can see, even with having tripled in the past year, the PE ratio of this stock is still below 8. So these are not richly valued stocks. These are value stocks. So the next criteria I use are valuation criteria. First, I ask the company to be profitable, and next, I expect the price to sales ratio to be under 5. Many of the meme stocks, their price to sales are greater than 10 or greater than 20, which in either case is crazy. A price to sales of 5 is actually high by traditional standards. Finally, I ask that stocks have a daily average volume of greater than 50,000 shares. That's not enough volume for many people, but my purchases of 100 shares or less typically remain quite hidden with this kind of volume. Now for options, this would not be anywhere close to being liquid enough, but I'm simply buying and selling shares. So when I run the screen, I get 65 companies. You can see here that's over 4 pages. And with Finviz Elite, you can export to a CSV file, which I find a little more convenient. So here's a CSV file. I've just put it in Excel. And so the circled columns here are the weekly, monthly, quarterly, and yearly returns. So I want steady performers. I don't want stocks that have gapped up for technical reasons, like reverse splits or something else, or stocks that have only been trending for a week, but have been down the rest of the year. So to get a measure of steady returns, I simply average the weekly, monthly, quarterly, and yearly returns, and kind of use this to rank the companies. So I want something that's been doing well for a while. So to see why I average the returns over multiple time intervals, let's compare a good stock on the left, which is Arch Resources. It's been trending steadily upward. Compare that to a bad stock on the right, which is Tenneco, which has been declining significantly for the better part of a year. It had a huge spike upward a few weeks ago. Maybe that was a reverse stock split. So this huge spike is going to skew the short-term returns, but less so the long-term returns. So at least by kind of averaging over multiple time periods, I can try to ferret out stocks that have these kind of spikes. And even sometimes I don't, but I just go and manually look at them. I look at the stock before I invest in it, and if I see that it's spiked for some reason, I just don't invest. So I've been trading this strategy for about 2 weeks. The SPY is cratered, but I'm up about 5% from where I started. I'm only half invested. The other half is cash. So in the short term, at least, it's really working. 2 weeks of performance does not a strategy make. So we'll see how I do over the next 2 months to a year. But I'm going to keep. I'm trading this on my big account now. So here's a graph of the returns of the 20 plus stocks that I trade over the last 2 weeks. Several of them are up 30 to 40 to 50% in 2 weeks alone. If you want to research the individual names, just hit the stop button and you can write them down and do your own research. But here I highlighted the top 4 performers. IPI is Intrepid Potash. It mines potassium chloride for agriculture. Potash supply is imperiled by the Ukraine war. AMR is Alpha Metallurgical Resources, which is a coal miner. RES is RPC, which is an oil and gas service company. It's been an incredibly steady performer over the last year and like tripled or quadrupled in price. So finally we have Arch Resources, which again is also a coal miner. So you can see a trend here. These stocks are basic materials and oil, basically, and agriculture. So I didn't go looking for these stocks. I basically let their excellent returns guide me. That's the essence of trend following. I'm not a macroeconomic forecaster. I can't predict direction in the future. All I can do is say, well, for whatever reason, here's a group of stocks that have gone up in the last month, year, week. And let's hope that this trend continues. And hope is basically what it is. But would you rather hope that a dog stock would turn around, or would you hope that a solid performer would continue to perform solidly? I would choose the latter. So getting into the stock is the easy part. Getting out is the hard part. So here's 450 days of a cool stock, UAN, which makes nitrogen fertilizer. It's also been affected by the war. The yellow curve is the stock price, and it's actually fallen this week. So the question is, do I? Obviously, over the past year, it's done well, but do I make a trading decision based on what's happened in the last week? And it's fallen a lot in the last week. So I just stay in and get out. So if you recall my previous video on price slope, what I do is I basically fit a straight line to the previous, in this case, 10 days of price data. And I plot the slope of that straight line here. It's an oscillator. It just tells us the short-term direction of the stock. What is the stock over the last 10 days in the aggregate? Is the stock going up or is the stock going down? So you notice that the price slope of UAN has just as of today gone negative. So I'm going to sell the stock because this is the criteria I'm using. I could easily just place a trailing stop on the stock as well. But for now, I'm going to use this price slope method to make entry and exit decisions. So we'll see how that goes. At least it's a system. It's an objective, unbiased technique to enter and exit. So we'll see how that plays out. Anyway, I hope you enjoyed this video. I've been pretty happy with this kind of trend following. It's dumb, to be honest with you. There's no rocket science here. It's like the older I get, the dumber I get, but I think I finally stumbled on something that makes sense here. So let me know in the comments what you think. This is a long way from, trading poor man's covered call or whatever, but I'm evolving, and I think you should evolve too if you're not happy with your results. So we'll see you later.